Hey guys, welcome back to a brand new video. I'm RexFinance and I sure hope you like the color red because we're seeing a lot of it today. As I'm recording this video, the Nasdaq alone is down by more than 2% and there's still several hours left in the trading day. This comes after the firm named Fitch downgraded the United States' credit rating from AAA to AA+ or positive. AKA they are no longer calling the United States debt risk-free. And if we're being honest, this really is no surprise. It was just a matter of time before something like this happened because they actually warned us back in May, citing the debt ceiling fight in Washington. And their explanation yesterday was that the repeated debt limit political standoffs and last-minute resolutions have eroded confidence in fiscal management. You don't say. To put this further into perspective, right now the total public debt as a percentage of GDP is at 118%, almost 119%. So our federal government has more debt than our current GDP. That's how scary this is. Now, this has been downtrending since the pandemic era, which would be a really good thing to see continue, but over the long term, since the 1980s, you can see we've been in a long-term uptrend with this. It's really on an unsustainable path, and we can even look at the amount of interest we're paying on this debt, and the government is paying almost $1 trillion in interest payments on this debt, which is nearly 4% of our total economy. That's the highest since 1999. Fitch said that if we completely suspend our debt ceiling or set a quote-unquote very high borrowing limit for our government and pair that with debt to GDP normalization and stabilization, that they would consider re-upgrading our credit rating. Isn't that just what we need, our government to not have a debt limit and to not have a borrowing limit? Yeah, that just sounds great, right? And it's true, this is how our government gets its money. They print money and borrow money so that they can pay off their bills and pay off their debt. It's a never-ending cycle. But believe it or not, this is not the first time our credit rating has been downgraded. It also happened in 2011 when Standard & Poor's, aka S&P, cut the top AAA rating by one notch a few days after a debt ceiling deal. So they gave very similar reasoning today as they did in 2011. They cited political polarization and insufficient steps to right the nation's fiscal outlook. Its rating is still AA+, the second highest. Based on this, today's credit rating downgrade is a carbon copy of what happened in 2011. And yeah, that is kind of scaring investors because that caused Black Monday. And no, we're not talking about the Black Monday that occurred in 1929 where the markets fell 12.82%, and we're not even talking about the Black Monday that happened in 1987 when the Dow Jones Industrial Average fell 22.6%. If you didn't know, we actually had a Black Monday in 2011 following this credit downgrade. The Nasdaq fell 6.9%, the S&P 500 fell 6.66%, and the New York Stock Exchange lost 7.05%. And just by coincidence, wink wink, the government launched a probe into S&P just a few days after they lowered the nation's credit rating, and the government was trying to find S&P's involvement in the great financial crisis. And a few days after that, Standard & Poor's president stepped down. Yeah, this isn't sketchy at all. So if by chance you're watching this video and you work for Fitch, you might want to watch yourself. We're seeing it all over Twitter today. Bears clinging to this, hoping it's the first domino to fall in this great market crash that they've been predicting since basically the beginning of 2022. And I have to say, bears could end up being right about this, although I don't think it's likely. In yesterday's video, I don't know how I do it, but I timed it about perfectly again. I promise I don't have a crystal ball. But I said that the markets were getting ripe to have disappointing headlines come into the news cycle. Did I think it would come via a credit downgrade? Probably not, but still, the markets took this as a very bad news headline, and it is. It's a negative news headline, and because so many investors have joined the bull train, we priced in good news or great news. So anything that comes in as less good or even bad news is primed to tank the markets. If you want to watch that video, click the eye in the top right-hand corner. It's very easy. It'll open in a new tab and you can watch it after this video. But in that video, I also mentioned that one of the risks that I'm looking out for in the stock market that could tank the stock market is actually treasury yields. I mentioned my concern that specifically the 10-year yield popped back over 4%. This was considered risk-free money, but not anymore technically after that credit downgrade by Fitch, but I still consider it risk-free. But if this 10-year treasury yield stays above 4% or even keeps climbing like it has been, that poses a great threat to the stock market because higher bond yields result in crunched valuations. And this credit downgrade that Fitch gave us likely leads to higher treasury yields for a longer amount of time. Higher bond yields will crunch valuations specifically of the mega cap 8 stocks. I have a spreadsheet for my members where I track the outperformance of the mega cap 8, and it's astounding. I'll just throw it up on the screen. You can look at it. It's crazy how far the mega cap 8 have outperformed. Their forward PE valuations right now are at record highs of around 31 or 32. These are the companies that would be hit by higher bond yields for longer. And these are the companies that spearheaded this entire market recovery. But honestly, I do believe that this time is different. And I know people hate those words, but every single time is different. There are different variables at play today than there were in 2011. And when I look at the 10-year treasury yield today, yeah, it went up, but it really didn't go up all that much. Typically, when your credit rating drops, you'd expect to see your treasury yields skyrocket, and they just haven't. Maybe this is a result of Fitch warning us that they were going to downgrade our credit rating back in May. Or maybe it's the market just brushing this to the side because the economy still remains very strong. Even the most recent data we've gotten shows the economy remaining resilient. And the one big difference that we have today compared to 2011 is we're not going through a European sovereign debt crisis. Back in 2011, when S&P downgraded the US's credit rating, that was during peak fear of the European sovereign debt crisis when people thought the euro was going to fail. According to Investopedia, it was a period when several European countries experienced the collapse of financial institutions, high government debt, and rapidly rising bond yield spreads in government securities. So this likely exaggerated and magnified the effect of a credit rating downgrade on the United States government because there were already fears about the euro. And if the euro fails and now the US government defaults or the US dollar fails, where does our global economy turn to? That's what people were asking themselves. And in the end, although it caused another Black Monday in 2011, if you ended up buying at the beginning of August, you would have been up by 5 to 6% by the end of 2011. You can see that here on the stock market chart. It's kind of hard to do over the long-term chart, but 5 to 6% if you bought the dip. So that huge scare in 2011 with a credit downgrade, all it resulted in was a great buying opportunity for investors. And I don't see that being any different this time around. Bears will continue to float this headline around as signs that their thesis is finally coming true, but I just don't think it is. A credit downgrade from AAA to AA positive really isn't that big of a deal. It's not going to stop people from buying treasuries or bonds, and if people buy treasuries and bonds, that ultimately sends rates lower or caps them. Now, if we start talking about even further credit downgrades, lower than AA positive, that's when I think you could actually see the market have a lasting correction or crash. And I'm not implying that I think the markets are just going to skyrocket back up from this dip. In fact, I hope this dip lasts a week or two. But I really struggle to see the markets having more than a 5% dip off of this headline because it really doesn't matter all that much. Are the mega cap 8 overvalued right now with a price to sales ratio of 6.1 and a price to earnings ratio of 30.9, essentially 31? Yeah, maybe, but we also need to consider the fact that analysts have earnings expectations very, very low right now because they're still pricing in a recession. So as they revise their estimates, these earnings are going to go up, which brings these forward valuation multiples down naturally. We also need to consider the fact that the mega cap 8, we're talking Google, Amazon, Apple, Meta, Microsoft, Netflix, Nvidia, and Tesla. All of those companies are at the forefront of the AI revolution, which could be our next big driving factor in the economy. We can't even wrap our heads around the total benefit that AI could provide for companies and people over the long term. You also have developments with quantum computing taking place. What's that going to do to the efficiencies and margins and profits and sales of these companies? It's probably going to send them higher. These are going to be the most efficient companies in the world and also the most efficient companies that the world has ever seen. And as a result of that, investors are probably willing to pay a pretty penny or an extra amount of money for the rights to these companies' future cash flows. So maybe they're due for a sell-off and a little bit of a dip or correction, but also maybe this is the new normal for the next 10 to 20 years where these companies are going to trade at a 25 to 35 forward PE ratio, and that's just the way it is. So I am absolutely not going to sell out of my stocks because the credit rating in the US was downgraded. Sure, it's something to keep an eye on, but the companies I own right now, in my opinion, are very undervalued. I'm not going to take profits on my stocks based on this headline and risk losing out of my position for years and years to come. I could forfeit my position and never have that buying opportunity to buy back in, and I will miss out on all those gains. I'm chasing the whole loaf of bread, not just the breadcrumbs. If you guys are new here or returning and not yet subscribed, I would greatly appreciate that subscribe button down below. Comment down below how far you think the stock market's going to fall as a result of this headline. But with that, have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.